Walser Wealth Management. Now, of course, stocks outperform, but there's more risk, right? So you need to have that balance. Tell me, Rebecca.
It's true, Nicole. I mean, obviously, people, as they start to retire, they move more towards fixed income bonds. We used to be able to do that a lot more, but unfortunately, what we call lower for longer, the lowest interest rates for the longest period of time in the history of our country, has led many people to just not be able to generate enough cash flow on the bond side of the equation, which has basically made them put more on the equity side of the equation. And if you look at equities from 1930 to 2019 with dividends, it's right under 10% annualized return. The problem, of course, Nicole, is when we have, a coronavirus, or we have, a great recession, or we have a .com crash, these things happen. And when you're retired, that's the problem. So you definitely have to still diversify. If you're trying to just chase alpha, chase returns, and you have everything in equities, you're going to be upset when those performances are depleted and go down, because the market is volatile, and we do have every 7 years, somewhat of a decent sized correction, and we should be prepared for that, and we should plan for that through diversification.
Right, the diversification is so key, but you talk about some other assets that you could have, such as real estate, cash,
yes,
right? Tell me, expand
absolutely.
on that.
Yeah, so, I always approach everything from a tax perspective, because, I also am a tax lawyer. So I build a portfolio with also a tax perspective in mind, which I think is so key, especially now with this decade being the retirement of our baby boomers, which is going to really shift a lot of things around when those boomers retire en masse. But real estate over the history of time has been one of the best inflation hedges that we've ever had. So a lot of real estate people are real estate only people, Nicole. They are just 100% all in the real estate world, and they don't believe in equities. And I think that is a mistake. I think that you absolutely can pull both an equity portfolio along with some size of a real estate portfolio, not leaving everything in real estate, but it's a great inflation hedge. I also do agree with your previous guest that basically we need to have 100, at least one full year of just cash, liquid cash, because let's say you do get laid off when we have a global pandemic and your company does have to furlough you and it doesn't get, reopened right away. What are you going to live off of? This is when people are going to that 401k prematurely and having to do cash outs or taking out a hardship loan and not being able to repay it for whatever reason. So you have to have an emergency fund, but you also want to look beyond sometimes just equities. Especially if you're within 10 years of retirement or you're in retirement, thinking that you can just always live off just equities is a problem, because you will have these dips, and that's where your 1 year of liquid cash reserves will really come into play. You can live off of that for a while and let the market recover, and then once again resume distributions when it makes sense.
What about a more aggressive strategy, right? If I'm not 10 years close to retirement or in retirement, what is your most aggressive strategy?
Well, obviously it depends on what kind of level of investment we're talking about, but certainly hedge funds, leveraged funds, funds where you're seeing them. I cannot tell you, Nicole, this year how many people have called up and asked about certain ETFs that are leveraged on the S&P, and it's like, whoa, this is a really new phenomenon that people are becoming aware of. So obviously a lot more risk, and you really want to have somebody who has the reserves available, because that can go really badly, as we know. But so yeah, definitely leveraged positions. That would be your most aggressive strategies, where you're actually, getting more than what the market does. You're taking a bigger bet. You've got obviously advanced strategies, calls, puts, straddles, all these kinds of new and more aggressive things, not for your average Joe investor who just basically has a 401k and maybe an IRA and that's it. Obviously there's a lot more aggressive strategies. Day trading, obviously people are doing that. But so, for the average guy, if you really wanted to be aggressive, I would say, what we normally look at is, in terms of diversification, is you're definitely weighted toward the equity side. If you're looking for beyond that, Nicole, what's even more aggressive than that, because I've got a really long investment horizon, then you're looking at your leverage strategies, where you're actually getting more than the market return because there's leverage.
Tell me more about the leveraged funds. Do you have some that you recommend? I know they're 2 times or 3 times. People are betting one way, and they may be betting up or down, but it's not just one time your money. It might be 2 or 3 times. Do you have certain recommendations that you give, whether it's for ETFs, for investments, for the leverage, and for the less aggressive folks? What are some of your recommendations these days?
I would stay away from the leveraged funds for right now, unless you're just like, you don't care about losing money. Not because I believe that the market is not going to recover, because I actually do have a really positive outlook for this market. I actually think that the case counts that we're seeing is just that. It's just a factor of a combination of factors of increased testing. We're getting a lot of younger people that are asymptomatic, and you're not seeing the hospitalizations and the death rates really be aligned with the increase in cases turning positive. So I think that we're still going to continue to open successfully. We're going to get through this little bump of this, increased cases, and we're going to keep, I believe, and just saying it out loud, Nicole, forecasting it to come true, that we're going to have a positive. But still, with a global pandemic and the close down of the world, I don't think this might be the year to actually take a leverage position unless you're extremely aggressive. So right now, I would say that would not be something I would be recommending to anybody on a general basis. Certainly, when we had the 10-year bull market and we were, we had some great years in there. 2019, incredible year to be in a leveraged position. Not necessarily sure with the shutdown not being fully over and not knowing exactly where consumer spending is going to come back at, with how many layoffs are eventually going to be full-time realized job losses. Don't think that's the best recommendation at this point.
Are you still long-term thinking the market goes higher and things get better?
I do. I just think it's a timing issue, right? I just think that we need to get back to work. I mean, as I've talked about so many times, Nicole, 2/3 of our market is consumer spending based. So we have got to get people back out and spending. And the more restrictive we make it, the more difficult it becomes to go back to the movies. And I know some people aren't going to want to go if everybody's not wearing a mask. And I understand all of these things have to get worked out. Are we going to be able to go to the football games? Are we going to have packed arenas? Or are we going to have half social distance arenas? What are we going to have? So all of these things have huge impacts. People don't understand that you go to a half full restaurant and the profit margin on that business is not being realized, because restaurant profit margins are so razor thin. They make their money on alcoholic beverages and volume. So we just don't know until we finally get back to some sort of normalization of back to normal, whatever that looks like. That's when we're going to be able to determine what is the long-term economic impact. So I do see us getting back, Nicole, to a really strong economy even this year. I just don't know what our new normalized level is until we really have more data on what the reopenings are looking like and how really consumers are going out and really re-engaging in the markets.
Right. Yeah, good points. Rebecca Walser, great to see you. Thank you. President,
Thank you.
Walser Wealth Management. Thanks, Rebecca.